Hey guys, we're back. Lance Martin, Coldwell Banker Town and Country, and our October 2022 real estate market snapshot. So I believe somebody once said, may you be blessed to live in interesting times. Well, I certainly feel when it comes to the real estate market and certainly the economy in the United States, we are living in some very interesting times. So that being said, I'm going to give you our first commercial for our 2023 real estate market forecast. We have it slated for March. We normally hold these every single March. The last few years have been a little messy with COVID and rescheduling live events. But anyway, we will be meeting in March live somewhere. So to be determined, but you're going to see a lot of stuff on our upcoming market forecast over the next several months. The last few months, I've been using this QR code to try to distribute some information to you. For those of you that have clicked on it, it does stay active and I refresh it with new content regularly. However, today, there's going to be a lot of new content that I'm going to reference in today's video that will all be available to you on this QR code. So if that's important to you, you want to see the full presentation, then just come back here, click that, and you're going to find everything that you need. One of those things that you may want to reference back to at a later date is last Wednesday, UCR and Beacon Economics, or the UCR Riverside School of Business and Center for Economic Forecasting and Development, also with Beacon Economics, did their 13th annual Inland Empire Economic Forecast Conference. That was last Wednesday, October 5th. That entire presentation that Dr. Chris Thornburg did is on that QR code. So you can go back and take a peek at it. Some very, very interesting information. In addition to that, Chris's partner, Tanner, did a very specific Inland Empire section of the forecast. It's a totally separate presentation. It was also done last week. It specifically targets the Inland Empire. Very good stuff. And I am going to share a few slides of both of these presentations in today's presentation. So if you want all of them, you're going to go to the QR code and you'll be able to find them. Also, I believe on Wednesday of this week, today this video is being shot on Monday, October 10th. On October 12th, the California Association of Realtors is going to come out with their updated market forecast. And it'll probably be the same day or the next day. I will have CAR's market forecast posted to that same link tree. So keep an eye out for that on probably late Wednesday or Thursday of this week. So should be some good stuff, and I'm very interested to see what their forecast is looking like. Oops, excuse me. I've been holding this Ben Bernanke slide, or excuse me, Ben Bernanke. Ben Bernanke just won a Nobel Peace Prize, by the way, in economics. Maybe I've got Ben on the mind. Actually, it wasn't Ben. Yeah, it was Ben. At any rate, Jerome Powell. This slide's been up here since June 15th with his press conference. I've decided to leave it up one more month, I suppose. This is the quote, which I will not read. But why am I leaving it back up? Because Chairman Powell appears to be hell-bent on resetting at least the real estate market, if not the entire United States economy, with Fed policy. So we've been talking about this for several months. If you were ignoring it back in May and June, it's becoming increasingly more difficult to ignore the moves that the Fed is taking and making, and what reset that may or may not done. Now, I pulled this slide up for a reason. An argument could be made that there is a concerted effort to reset the real estate market. And for the most part, that's really all we talk about here is the real estate market. So there's definitely some resetting going, or how far are we going to go on this, I guess, is to be determined. But at any rate, I've left this slide up from last month as well. Part of that reset is the Fed's plan to do some demand destruction. Well, if it is, they've accomplished that. Is their mission accomplished or a work in progress? That really was a question for me last month. It is definitely a work in progress. There appears to be no end, at least that I can see, for the Fed's actions to basically, in their view, attempt to reduce or eliminate inflation, and by doing so, raise interest rates and a variety of other things. But interest rates are so sensitive to the real estate market. I really feel like we in the real estate business and those home buyers and sellers truly have a target on our back because of how interest rates affect what we do. So the question is not a question. I don't believe the Fed feels they've accomplished their mission. I believe they think it is a work in progress, and that work continues to my discussed, shall we say. So here we are. We're going to run up our numbers here. California market update. We're also going to take a look at interest rates. They're ridiculous. We'll talk a lot more today about interest rates than we have in the last several months. So here we go. By the way, before I did this, I wanted to make it clear you may not be aware, we have offices in 4 different locations: Covina, Claremont, Redlands, and the city of Moreno Valley. The reason that I do the 3 counties, LA, San Bernardino, and Riverside County, is because those are where my offices are located, okay? So if that wasn't specifically clear to you, I tend to focus on those markets more so than the others. And some of today's presentation, you'll notice I might kind of leave out a little bit of the LA market and a little bit more of an Inland Empire focus, because 3 of my 4 offices are a little more centric to the east side and the Inland Empire. So at any rate, just a little reminder if you weren't aware of where my offices were located. So let's start with LA County. A lot of interesting stuff going on here, okay? So for those of you that have been watching these, I know they can get a little, oh my gosh, here we are with the charts again and the bars, and they're up and they're down. This is the 24-month run of median price in LA County. This is the 12-month run. Again, it tends to isolate this little hump. This is May of 2022, which, by the way, we're going to do LA County, we're going to do Riverside County, we're going to do San Bernardino County, and my spotlight city this month is the city of Menifee, which is right down the road here from Adam's studio. We're in Canyon Lake at Coldwell Banker Associated Brokerage. Again, thank you guys for the use of the studio. But I'm going to do spotlight city of Menifee, just so you know, in case I forget to mention it. The peak in every single, the 3 counties plus Menifee, is May, okay? So in other words, property values, at least as of the moment, we've got this peak of May of 2022, and since May of 2022, we've started to see this ever so slight pullback. Now, if you look in, by the way, you might say ever so slight, that doesn't seem like a slight pullback. Well, we'll talk about what that number is. I will tell you though, the difference between August and September was generally pretty minimal in all of the marketplaces. So we certainly did see from May to June pullback, June to July pullback, July to August pullback, and then from August, September, not so much. So what does that mean for prices? I guess we're gonna find out. But so, right, so this is LA County. This is my isolated chart. We started doing this a few months ago. So this is what we've seen happen from the peak, from May to now. Okay, so yeah, I don't like that trend line. I mean, that's definitely a downward trend line. And this is our year to date, which, by the way, does that look remarkably flat? Pretty much flat, not quite exactly. So what do these numbers actually mean for Los Angeles County? Median price, $785. We're 1.3% higher than we were in September of last year. So this is September 2022 compared to September of 2021. 1.3% higher, basically flat, okay? I'm gonna pause here for just a second because a lot of these charts tend to look the same, but there are some very distinct differences, say for example, between San Bernardino County and LA County. But under normal times, if we were at a 1.3% annual appreciation or year-over-year appreciation, I think I'd say, yeah, okay, it's a pretty soft market, but hey, we'll take it, all right? But we haven't been in normal times. We've been in extraordinary times with just extraordinary appreciation. So when you start to see this 12-month change down in single digits, and at this rate, low single digits, that tells me something anyway, and it tells me that things have definitely changed. So that 1.3% is basically 775 to 785, 1.3% is what we're looking at. That was 12 months ago. Interestingly, 24 months ago in Los Angeles County, we're up 15.4%, which, by the way, is a big, big number, unless you want to compare the number that we were looking at not that long ago when we were looking at a 20% year-over-year appreciation and another 20% year-over-year appreciation. So several months back, that number was closer to 40% appreciation over a period of 2 years. So to see us go from a 40% down to a 15%, having said that, as painful as the market is right now on these prices, and a lot of people are concerned, that's a very, very big number for a 2-year curve, or excuse me, for a 2-year price appreciation. So, but what does it mean for the last 5 months? Remember that chart I showed you from May to September? It's a 7% drop in median price in the last 5 months in LA County. That's what has a lot of people concerned, a lot of people talking about crashes and adjustments and corrections, and to use my term that I stole from Chairman Powell, reset. Okay, so at any rate, a 7.1% pullback in LA County over the last 5 months, and a year to date, that last chart, January to September, I think I inserted this a month or so ago. I never have done a year to date chart ever. I don't know that I've ever even paid any attention to it. But since things are going up and down, we have a lot of volatility, I said, okay, well, let's just relax a little bit. Yes, we've pulled back since May, but if you go back to the beginning of the year, we're still in positive territory, 2.2% for LA County. So at any rate, a lot of stuff going on here, but we'll have a chance to kind of revisit as we go through the other counties as well. So this is supply and demand for LA County. Again, the trend is downward. Red bars are active listings. Blue bars are pending sales. This is the isolated 12-month chart. Again, it looks kind of flat on listings. This is the supply and demand. I added this last month, excuse me, not supply and demand. This is month supply of inventory. How many months of inventory are actually available on the market right now in LA County? That number, by the way, is 3.5 months of active inventory, meaning at the current absorption rate, buyers and sellers coming together, if no new listings came on the market at all from today forward, it would take 3.5 months for the existing demand rate to basically absorb the current supply. That's not a bad rate, okay? 3.5% absorption rate is, I don't know, I feel good about it. You got to remember though, we've been coming off months of like less than a month, a half a month, 2 weeks worth of inventory available. So when you put it in that context, things have definitely changed. So where are we with homes for sale? LA County, 16,300 and change, down almost 4% from a year ago, down almost 11% from 2 years ago. Okay, fair enough. We still have an inventory challenge, not a big deal, kind of sort of understand that. These are the numbers that are scary, and we started pointing these out a couple of months ago, and they continue this trend of ugliness, to be honest with you. So homes sold, 3140. 34% fewer than a year ago, 36.6% fewer than 2 years ago. The buyers are just holding back. Why is that? Interest rates, economic concerns, maybe what Chairman Powell's doing. Turn on the news, and if I'm a buyer, geez, maybe I'll just kind of ride this out for a little bit, see what happens. So again, these are the LA County numbers. Let's jump into Riverside. Similar, but very different, to be honest with you guys. Very, very different. Again, there's our 24-month pricing chart. There's our 12-month pricing chart. Again, we still have that similar little rise here. This is May of 2022. But if you go back, I'm not going to do it, but if you go back and take a look at the LA chart, it just doesn't seem quite as pronounced. And then we seem like we almost got a little bit of a flattening in the last couple of months. Well, we have seen a little bit of a flattening in the last couple of months. So that's your 5-month chart. That's 4.6%, which we'll talk about in a minute. And there's your year-to-date chart, which is, again, flat, 1.8% year-to-date change in property values. That's upward. So here we are. Median for Riverside County, 565. That's up 6.6% from a year ago, 28% from 2 years ago. So 441 to 565. Someone do check the math. It should be 28.1% difference in price above. This is one reason why those of you that are, oh my God, we're going to have a gazillion foreclosures and the market's going to get flooded for foreclosures. No, we're not. And one of the reasons why we're not is because we're still 28, at least in Riverside County, as a whole, we're 28% higher in property values today than we were 2 years ago. Now, does that mean that someone who just bought their house tomorrow has run into some trouble, maybe didn't put as much money down, has an equity position that's not maybe as nice as the people who bought previously? Are they going to have some distress? Sure. Doesn't mean we're not going to see anybody lose their property or do short sale or see some creative stuff going on the side. But this tsunami, it's just not there. These numbers are just too large. But Riverside County, 4.6% lower median price today than in May of this year, and 1.8% higher than year to date, which again is, let's just call it flat, I mean, no change. It'll be very, very interesting. I have a very good feeling by the time we get to by December 31st of this year, it's entirely possible this is going to be a negative number. In other words, we might very well see some property values continue to pull back in the last quarter of 2022. Why is that a possibility? Because it's not unusual for prices to pull back in the last quarter of any year. An interest rate environment being what it is, it's entirely possible. Supply and demand for Riverside County. Again, a little different than what you saw in LA County. We're actually seeing an inventory trend upward. What? An inventory trend upward? Yes, an inventory trend upward. Even though we fell off from August to September, that's more normal. Okay, it's normal to have fewer listings in September than it is in August. Some of this stuff that's been going on with COVID the last couple of years have kind of completely changed our cycle a little bit, but we are actually seeing a little bit more inventory. Unfortunately, the blue trend line, homes, buyers, and sellers coming together and opening an escrow, is down. So what does that actually look like? Oh, by the way, this is the absorption rate or month supply of inventory. LA County, if you remember, was 3.5 months. Riverside County is 1.5 months. Still a very small level of inventory, even at the current rate of absorption. So 7,500 homes for sale, 16% more than a year ago, 19% and 0.5% more than 2 years ago. So even though we've been crying and crying about inventory levels, and I can continue to cry, trust me, we need more listings on the market, even though the demand may be slowing a little bit. We're comparing this to September, okay? And you know, September is not traditionally a great month, and we're coming off of some really rough months. For the most part, the summer was a bad period of time in the real estate business from a standpoint of volume. We just didn't see as many sellers hit the market as we normally would want. So even though these are positive numbers, that's fantastic. I'd still like to see them higher, but what I want to see and what's probably going to happen aren't going to happen. I would anticipate that the inventory on the market is not going to be any much different in October, November, or December. If anything, it's probably going to be a little bit less, not unusual. Homes sold though, again, 32% fewer homes, buyers and sellers coming together in the month of September from a year ago, and basically the same, 33.8% from 2 years ago. This is one reason why us industry people, brokers and owners and agents who are trying to make a living selling real estate, it's like, well, geez, you know, we need to sell some houses. So we need to get those buyers and sellers to come together. Why is this happening? Interest rates. I mean, it's all interest rates and everything that kind of flows from that. So those numbers are pretty rough. San Bernardino, interesting when you look at San Bernardino, by the way, it doesn't really show it here. It's hard to see. Median price in San Bernardino County ticked up ever so slightly from August to September. So you'll see, if you go back and look at some of the prior months' videos, you'll see, you know, what those numbers were. But bottom line is, price ticked up ever so slightly last month. That's our 12-month isolated chart, and there's our 5 months. So you can see it a little bit better here. This bar is just a smidge higher. I think it's about $5,000 higher on median price in the county of San Bernardino. And there's our 12-month chart. By the way, all of these charts, just like what I mentioned to you earlier with the UCR and Beacon Economic stuff, they're available on that link tree. All of these are available to you on that link tree. So if you want to isolate it and pull out something that's important to you, there they are. Okay, so what does this mean? San Bernardino County, 498. That's up almost 10%, 9.3% from a year ago. That's extraordinary. By the way, it's different than LA. It's different than San Bernardino. Those were almost flat, 1 or 2% appreciation. Well, San Bernardino's still holding strong, a little bit lower of a base. So that was 455 a year ago compared to 498 now, and 2 years ago at 392, which is still 26.9% higher. Extraordinary numbers. Also, if you come on over here and you take a look at here, the numbers are a little bit different. Not as quite as much price destruction between May and September, although it is price destruction, 4.2%. But year to date, a 4.3% year to date appreciation for the county of San Bernardino. If we ended any county, city, any marketplace with a 4% appreciation on any given year, I would be a happy camper. It's a stable market, kind of a boring market, nothing to get too excited about. People buy houses and sell houses in a market that has a 2, 3, 4, 5% appreciation rate. When we're coming off a 20% appreciation rate, we've been talking for a long time, when the party stops, could be painful. We're in that painful period right now. Party has stopped. San Bernardino County supply and demand. Again, inventory looks very similar to Riverside. It's an upward trend. Again, almost the same as the Riverside chart. Just pulled back last month, but still upward. But unfortunately, the pendings continue down. That's the 12-month chart for the supply and demand for San Bernardino. And San Bernardino, similar to LA, 3.2 months supply of inventory in San Bernardino. So about double what you have in Riverside County, and almost identical to what's available in LA County, but the prices seem to be holding a little bit firmer. So what does this mean? Homes for sale, listings are up 7% in 12 months, 13% in the last 24 months. Painful part though, guys, here it is again, almost 38% fewer home sales than a year ago, and 38.3% fewer home sales than 2 years ago. Again, interest rates. The buyers are sitting back and saying, hey, what are we going to do here? Spotlight City. This was a surprise to me. I thought I was going to pull up San Bernardino, city of San Bernardino. Last month, if you recall, we did the city of Riverside. The reason I like to pick larger cities because I use median price values, and when you use a median price value, the larger the sample, the more accurate the data is. So I figured, well, we just did we did Riverside last month, let's do San Bernardino this month. And then I started looking at the data, I said, wait a minute, there was more activity in the city of Menifee last month than there was in the city of San Bernardino. So I said, all right, well, let's take a look at what's going on in Menifee. So here's your price chart for Menifee, 2-year chart. Again, it is, even though Menifee's not a small city, it's also certainly not a large city. So just keep in mind, the smaller the sample with these charts, the choppier they get, especially when you use median. So at any rate, here's our 2-year chart for pricing in Menifee, our 12-month chart for the pricing in Menifee. Again, still a downtrend. Menifee, as the other counties we've talked about so far, everything I've looked at so far this year has had a price peak in May. That was it. That's as good as it's gotten so far, and we pulled back from then. Interesting with Menifee, they pulled back in June and then back up in July and then back down again in August and basically flat in August, or in September rather. So what does this mean for Menifee? Oh, and this is the 12-month chart, or excuse me, year to date. I don't use this chart, so I'm not accustomed to saying the year-to-date chart. So what does it mean? 564, 13% increase from a year ago, 31.7% from 2 years ago. Super, super strong. I mean, there's no other way to put it. Just a super, super strong marketplace in Menifee from a pricing standpoint, even with the 4.4% pullback from May. Okay, but year to date, 6.6% up. So what does Menifee look like on a supply and demand side? This was also kind of surprising to me, although it looks kind of similar. Inventory trajectory is up, very similar to the other charts. That's your 2-year, that's your 24-month. So what, again, the absorption rate, 2.7 months, so somewhere in between San Bernardino County and Riverside County, although Menifee, of course, is Riverside County. But in Riverside County, I believe the absorption rate was 1.5 months. Well, in the city of Menifee, which is in Riverside County, it's 2.7. But again, very healthy level of inventory. I'm not sure I'm going to be using the word healthy a whole heck of a lot in these presentations coming up. So again, smaller data sample, homes for sale in Menifee, 654. For those of you agents that work, wait a minute, I work Menifee, there's not 654 houses for sale at the end of September. You're correct. This is any house that was listed in the city of Menifee for at least 1 day. So it had to be active in the market for at least 1 day. And by the way, that goes for all of the charts that I show you. So that doesn't mean that's how many houses are for sale right now, or in our example, we always do the prior month. So not how many houses were for sale on September 30th. That number's closer to 400. In fact, we pulled it today, and I think the number was right around 400, a little bit less possibly. But they were active at least for 1 day in the month of September, 654. That is a 20% increase from a year ago and a 52% increase from 2 years ago. Man, I went back and I triple checked it. Let's go back and take a look at that chart here real quick. So this is what we're looking at here. This is 2 years ago. Excuse me, this is 2 years ago. You got this beeline trend line way up. So that's what they're referring to on the active listings taken. That is a 54% increase in active listings in 2 years. Pretty extraordinary number. I haven't seen that in any other community that we've looked at. So again, 52.4%. Homes sold, however, same trend continues. Even though they've got more houses for sale, 35% fewer than sold, buyers and sellers coming together, 35% fewer than 12 months ago, and 20% or 19.9% fewer than 2 years ago. So again, the activity is pretty tremendous in Menifee. The values are holding in Menifee, but why are these numbers falling? Interest rates. Okay, we'll talk a little bit more about those. Oh, I guess it's time. So what's going on with interest rates? This is why I start off my presentation with that picture of Jerome Powell and the Fed chair and what he's been doing, and I have been completely obsessed with what the Fed's been doing. Frankly, we could have completely ignored what the Fed did probably for the last 6, 7, 8 years, other than they're not doing anything other than buying mortgage-backed securities and allowing basically rates to remain excessively low. But now that party's over. So this is from Optimal Blue. If you want a link to this, on the link on that QR code that takes you to Lance Martin's link tree, somewhere on there it says Optimal Blue interest rates on a daily rate. You can look at those anytime you want. It says October 10th. That is today, all right? However, bond market is closed today. Stock market's open, bond market's closed. So these rates are actually as of last Friday. So the Optimal Blue shows rates, and it's an index of rates. They take a whole bunch of mortgage companies across the country, they throw them together and they average them out. 6.8% as of Friday. The reality is I don't think anybody's going to be able to apply for a loan today and get a 6.8% interest rate. Will that change tomorrow? I don't know. If you go to the old Google machine and you say, what are mortgage rates today? Anybody can do this which by the way, this chart, anybody can get this. There's nothing protected about this. You can go to Optimal Blue and just search it and you'll have the same data that I have. But if you just do a straight Google search, say what are mortgage rates, you'll come up with this. Well, that's not 6.8, that's 7.4. And the reality is, and this was as of Friday, you're more than likely going to be looking at a rate somewhere in the low 7s, maybe high 7s, depending upon credit and a whole bunch of other things. I'm going to pause here because I've been saying for a while, what breaks the real estate market? What stops this train that we've been on? And by the way, our train definitely needed to slow down, but I don't know that anybody, at least I certainly don't want to derail the train or break the train. Well, this sustained interest rates, at 7.5 for a significant period of time, and I'll just call that a couple, 3 months, definitely do serious damage, if not break the real estate market, okay? It's funny, I thought I invented that word when it came to real estate, and several months back, or even a year or so ago, I was talking about, when does this, what are we going to do to stop this crazy appreciation rate of 10, 15, 20%? I said, well, I don't know about that. But I'll tell you what ultimately will slow it down is going to be higher interest rates. And then several months back when we started to get into the 4 and 4.5%, and there was talk about these higher interest rates. In fact, Adam and I, our videographer, have a bet where those interest rates are going to end up. And somewhere along the line, I'm like, well, geez, anything above 7.5 for a period of time breaks the market. Now, what do I define as break? It just basically throws a blanket on it. And I think just buyers will sit back and check out a little bit and either wait to see if it's going to get worse, or frankly just say, well, I can't qualify for what I want to qualify for. And I think all of the numbers that we've been looking at for the last 15 minutes reflect that, with those low pending sales coming down. So again, where's the interest rates today? This number is probably closer to what your average buyer is going to be looking at, or maybe higher. Having said that, they change all the time. I've been doing this for 35 years. If I've been in the mortgage business, or if I was a real estate agent, advising clients on interest rates, for the last 6, 7, 8 years, it was kind of like, just go talk to the lender and they're going to give you something and it's not going to change and you're going to be happy. This is like nothing I've ever seen, but it does remind me of probably the first 10 or 12 or maybe even 15 years I was in the business, where you had to pay attention to what the interest rates were. You had to make sure, should I lock? Should I float? Where am I with my transaction? Where am I with my rates? And is that going to be able to, am I going to be able to close escrow on this property if we see, like we did 2 weeks ago, where on a Tuesday or Monday, the market just went crazy in a 24-hour period. It kind of corrected. Very important though, guys, if you're on the buy side of a transaction right now, whoever your real estate professional is, hopefully it's someone at Coldwell Banker Town & Country, you need to be keenly aware of your lender partnership and what rate you can qualify for and what rate ultimately are you locked in at. Super, super important. So normally we would stop the presentation here. I'm gonna take just an extra maybe 5 minutes. I wanna go over some of the slides that Chris Thornburg and the team at UCR School of Business and the Center for Economic Forecasting and Development. I have to practice that because I'm going to introduce Chris. He'll be speaking here at a later forecast, and I always slaughter the UC Riverside School of Business's full name. So anyway, this entire presentation is available. This one you'll see has Chris's name on it. There are 2 presentations on that link tree, one for Chris and one for Tanner. Quite honestly, if you're only focused on the Inland Empire side, even though I know we have some LA County folks here, you're probably going to want to focus more on Tanner's presentation than Chris's. Chris's is kind of more of a macro look at what the entire state and country are doing. Tanner's presentation, where these slides are more of what's happening in the Inland Empire. So for those of you that are like, oh my God, Lance, this is just really tough. What are we going to do? Well, let me share with you some positive stuff. And I did intentionally pull out some positive stuff because I think it's important. And I'm not pulling out positive stuff just for the sense of being positive. I do think it's important because there's a lot of very interesting things going on out there. So this is California net migration. And for those of you that have been paying a little bit of attention, you've heard in the news, oh my gosh, California for the first time has a net population loss. People are migrating to other parts of the country, we lost U.S. House of Representatives for the first time in the history of our founding of our state of California. Fewer people, fewer representatives. So this talks about net migration by income, and this talks about net migration by education. Basically, who's leaving. Less than high school, some college. Well, I guess the graduate professors and degree are coming in. Everyone else is leaving. Leave that one alone, I suppose, for the moment. But why did I share this with you? I pulled this out because I wanted to contrast it by what's going on in the Inland Empire. Okay, so for all of the difficult stuff out there, and there's a lot of difficult stuff, make no mistake about it, there's some difficult stuff going on in our economy. I saw this last Wednesday, and I'd heard this, I'd kind of seen it, but it did make me pause a little bit. So pretty much across the board in the Inland Empire is the exact opposite of what we're seeing in the state as a whole. So net migration for the Inland Empire by income, and these are all different income classes, we're ultimately seeing a net positive. You can look at the thousands here. And net migration by education across the board, we're seeing basically people move into the Inland Empire. I think part of that, quite honestly, is affordability, okay? But as much as you hear that stuff in the news, oh my gosh, people are fleeing California, and frankly, you guys may know some people that have fled the Inland Empire. Say, I'm leaving Riverside, I'm moving to Texas, or I'm moving to Florida. Absolutely true. I've certainly had a lot of my clients do that. But on balance, we still have more people coming into the Inland Empire than are leaving. So take that for what it's worth. However, prices are up. What do we have here? Annual mortgage payments. So this is mortgage increases in the Inland Empire. And of course, a lot of that is interest rate driven. This concerns me. This is potentially a break in what's going on. This is pricing, which I do think is interesting. The gold bar is Inland Empire, the gold bar is California. The blue bar is the Inland Empire. So California prices are, of course, exploding as a state. I don't have an isolation of, say, Southern California, but we are certainly a little more affordable in the Inland Empire than we are in the state as a whole, and that, the blue bar, of course, would indicate that. So maybe we're having some migration from an affordability standpoint. Kind of sort of makes sense. Apartment vacancies are down, rents are high. Again, Inland Empire. This is another reason, quite honestly, why I think we have a little bit of price support on property values. We've talked about this before. Here's a graph that maybe will help some folks visualize a little bit better. If you're concerned about property values dropping, I get it. I just showed you some charts that show some property values dropping. But what's the alternative? If the alternative is I'm going to sell my house and I'm going to go rent something, well, you might just sit back and say, I think I'll stay in my house, okay? Or maybe I will buy that house if I can. The rents are interesting. Having said that, one thing that Chairman Powell is going to have very, very little control over in the short term, he might be able to drive down all sorts of other things in relation to interest rates. Rents are sticky. Generally most people are signing long-term leases a year in that neighborhood, and to see rent values actually decrease significantly at any point in the near future, I just don't see it happening. And we can have an argument as to, is it healthy that rents have gone up so much? If you're a landlord, I suppose it is. If you're a tenant, maybe not so much, but those rents are crazy. These are wages. Again, California, Riverside, okay, well, that's a little bit of a negative. Making more money in other parts of the state than we are in Riverside, inland. Oh, it is Riverside. I apologize. I thought I was back to the Inland Empire. So you guys can take a look at this. I think there's one other chart that we'll take a look at. And let's talk about employment change. So again, you've got to just focus on negative numbers. So basically what we're seeing absolute change in employment in all of these areas throughout the state of California. You see a whole bunch of negatives, some zeros and some threes. Well, the Riverside San Bernardino area is actually increasing in employment, okay? So again, even though we've got some stuff going on that we're a little concerned about, for me it's all interest rates, it's not all gloom and doom. And quite honestly, at least in our area, there's plenty of jobs out there. And again, maybe that's part of the problem with Chairman Powell is he wants to try to damper that down a little bit. So I think there's a couple other charts, and I'm going to blow past these. You guys can take a look at the entire presentation. So I'm going to end with where I started. We are definitely in a forced government, Chairman of the Federal Reserve, economic reset. All right. Very interesting times, quite honestly, quite ugly. More to follow. I would expect the remainder of this year, frankly, to be probably just play this video over and over and over until such time as I can stand up here and say, guess what? It appears as though the Fed chair has decided to pause any sort of future interest rate reductions or increase reductions. Good Lord, wouldn't that be something? Anyway, pause any future Fed funds rate increases. Until that happens, I think, frankly, we're going to be looking at more of the same. So I guess I'll see you in a month. We'll see what the Fed does over the next month, 2 and 3. We'll be here, and I believe that's it. So anyway, have a great October. We will see you next month.